planning to save money for future? If yes, then be ready for suffering a loss on your money. In older days, if we had to save money, we could keep it in a saving bank account. That account would have given us interest, which would have compounded over a period of time. And after a span of few years, we would have a substantial amount of money in our account. This method of saving money was risk-free and effective. The return was guaranteed. The money not only covered inflation, but also gave a boost of extra income to our pockets. These days, if you are saving money for the future, one way or another you had best be prepared to lose some of it. That is the implication of today's high inflation and very low interest rates. It means that real interest rates, what you can earn on your money after accounting for inflation, are lower than they have been in modern times. And it means the choice for a saver is stark. You can invest in safe assets and accept a high likelihood that you will get back less in terms of purchasing power than you put in. Or you can invest in risky assets in which you have a shot at positive returns, but also a substantial risk of losing money should market sentiment turn negative. For people who are risk-averse, they have to get used to the worst of all possible worlds, which is watching their little pool of capital go down in real terms year after year after year. Inflation outpacing interest rates is good news in certain circumstances. If you are able to borrow money at a fixed rate, for example, and use it to make an investment that will provide something of value over time, whether a house, farmland, or equipment for a business. But consider the options if you are not in that position. And instead, you are saving money that you expect to need 5 years down the road for the down payment on a house or a child's college expenses. You could keep the money in cash, such as through a bank deposit or money market mutual fund. Short-term interest rates are at zero or very close to it, depending on the specific place the money is parked, and Federal Reserve officials expect to keep rates there for perhaps another couple of years. Inflation has been at 4% to 5% over the last year, and many forecasters expect it to come down slowly. Now imagine if you have $100,000 and you invest them for 5 years in a fixed income account at an annual interest rate of 1%. After 5 years, your investment will be worth $105,100. However, if average inflation remains 4% during that period, after 5 years, you will need $121,000 for buying what you could afford to buy with $100,000 5 years earlier. Even the 5-year yield on Treasury inflation-protected security, a government-issued bond that is indexed to inflation, is a negative 1.83%. That means that if inflation were 3% annually, your holding would return only 3% minus 1.83%, or 1.17%. In exchange for protection against the risk of high inflation, you must tolerate losing nearly 2% in purchasing power each year. Even a little more risky corporate bond will yield around 2 to 2.5%, and with the added risk that the companies that issued the bonds will default. And it's still only enough to roughly keep up with anticipated inflation. Here's the most appalling thing about present situation for savers. Say you get 1% on a certificate of deposit during the time when we're experiencing 5% inflation. Comes tax time, you still have to pay income tax on that 1% interest as if it was a profit. Actually, you have suffered a 4% loss. Government should not treat interest as income until the point where the interest rate exceeds the inflation rate. Someone who buys bonds with ultra-low yields is collecting puny interest in exchange for taking the substantial risk that higher inflation or a surge in rates could more than wipe out gains. The reason being, when interest rates rise, existing bonds fall in value. The Fed, besides keeping its short-term interest rate target near zero, is buying $120 billion in securities every month through its quantitative easing program, and is only now starting to talk about plans to taper those purchases. That has the effect of putting an enormous buyer in the market that is bidding up the price of bonds, and that's pushing rates down. Fed officials believe the strategy of keeping easy monetary policy in place even as the economy is well into its recovery will help bring the American job market back to full health quickly. At the same time, Americans have accumulated trillions in extra savings during the pandemic, money they are parking in all sorts of investments, which has been pushing asset prices upward and expected returns down. Globally, the pattern of retirement savings across advanced nations points to continued low interest rates due to aging population. That helps explain why interest rates have been persistently low across major economies in Europe, the United States, and Japan in particular for years, even at times when those economies have been performing relatively well. So what you can do in such a situation? Perhaps it is better to keep a diversified portfolio. A portfolio which includes some stocks, savings, gold, and units of real estate investment trust. In this way, at least, you will be expecting higher profits while the risk will also be diversified. And most often, you will be moving at par with the inflation. That's all for this video. We will be back soon with another one. If you like the video, please subscribe to the channel and push the bell icon for notifications. Till the next video, bye-bye, see you soon.